You went to sleep last night with silver sitting at one level, you woke up this morning and it had moved again, and if you are holding silver right now, physical, ETF, mining stocks, anything, and you felt that familiar knot in your stomach when you checked the price, this video is made exactly for you, not for traders who live on 5-minute charts, for holders, for the people who bought silver for real reasons and are now watching it swing 5, 6, 7% in a single session and wondering what is actually happening, what they should be watching, and whether they should be doing anything different. I am going to give you a complete, honest breakdown of exactly what is driving this overnight volatility, what the signals are that actually matter for holders, and what specific things you need to watch this week. Let's go. First, let me anchor you in the price reality, because that is where we have to start. Silver hit an all-time nominal high of $121.62 on January 29th of this year. By late March, it had fallen to the high 60s. That is a 36 to 40% correction from the peak. Since the end of March, it has been bouncing in a range roughly between $69 and $77, with sessions that can cover $7 or $8 of that range in a single day. On April 1st, it surged over 7%. On April 3rd, it fell almost 7% on the same day of the same week in opposite directions, with magnitudes that would make most stock investors deeply uncomfortable, and the people who are reacting to every one of those moves, who are constantly checking the number and feeling either relief or panic depending on where it is, are the ones who are most likely to make poor decisions in this environment. So the first thing I want to give you is not a trading call. It is a framework for thinking clearly about what you are actually seeing, because overnight volatility in silver in April 2026 is not noise, it is signal, but only if you know what frequency to tune into. Here is the complete picture of why silver is moving so violently right now. And there are 4 distinct forces all operating simultaneously, all pulling in different directions, all changing day by day. Understanding each one separately is how you stop reacting to headlines and start reading the market. Force number 1 is the Iran war and oil. The United States and Israel have been conducting military operations against Iran since late February. The Strait of Hormuz, one of the most critical energy corridors on Earth, has been partially disrupted. Oil spiked to $113 per barrel at its peak, and here is the counterintuitive part that confused a lot of holders during March. You would expect an active military conflict to send silver surging as a safe haven, and it did initially, then it did the opposite, and then it bounced again. The reason for this confusing behavior is that the Iran war has 2 competing effects on silver, and they fight each other. The safe haven effect pushes silver higher. War, uncertainty, fear of dollar instability, all of that sends money toward gold and silver. The inflation Fed effect pushes silver lower. When oil spikes, inflation expectations rise. When inflation expectations rise, the Federal Reserve cannot cut interest rates. When the Fed cannot cut, non-yielding assets like silver become less attractive relative to bonds and cash. The dollar strengthens. A stronger dollar means commodities priced in dollars get more expensive for international buyers, reducing demand. This mechanism actually won in March. Inflation fear beat safe haven demand. Silver fell hard even while a war was happening. That is the market telling you something important. The Fed and the dollar are currently more powerful forces for silver's short-term price than the geopolitical risk is. So when you see silver drop overnight on a session where Iran headlines are active, this is almost always the reason. A new statement that sounds hawkish on the war extends the oil spike, raises inflation fears, pushes yields higher, strengthens the dollar, and silver falls. When you see silver surge overnight, it is usually the opposite. A ceasefire signal, a peace negotiation development, something that makes the market think oil comes down, inflation pressure eases, the Fed gets its rate cut window back, dollar softens, silver jumps. Watch oil prices every single morning before you check silver. Brent crude is your leading indicator. If oil is up overnight, silver is likely under pressure. If oil is down, silver likely has support. This single relationship explains a huge portion of the day-to-day and session-to-session volatility you are seeing right now. Force number 2 is the dollar and Federal Reserve expectations. This is connected to the oil story but operates somewhat independently as well. The US dollar index, which measures the dollar against a basket of other major currencies, has been elevated throughout this period. Markets are currently pricing in roughly 0% probability of a rate cut at the April 29th Fed meeting. The CME FedWatch tool shows only about 25% chance of even one rate cut by December of this year, down from over 90% probability of cuts that markets were pricing just a few months ago. That is a massive repricing of Fed expectations, and it happened entirely because of oil-driven inflation fears from the Iran conflict. For silver holders, this matters enormously. When the market thinks the Fed will cut rates, non-yielding assets like silver benefit because the opportunity cost of holding them falls. When the market thinks the Fed will hold or hike, that opportunity cost rises and silver faces headwinds. Right now, the opportunity cost is at its highest in years. And yet, and this is a critical point, physical demand has not collapsed. Industrial buyers have not stopped buying silver. The structural supply deficit continues. What has collapsed is the speculative premium and the rate cut optionality premium that was embedded in silver's price. The underlying physical market is still tight, which is why even with this difficult macro environment, silver has been defending the $67 to $70 support zone rather than collapsing all the way back to pre-rally levels. Watch the dollar index alongside oil. If DXY is falling on a given session, silver typically gains. If DXY is rising, silver faces headwinds. These two instruments, Brent crude and the dollar index, give you an early read on where silver is likely to move before you even open a silver price chart. Force number 3 is the NFP jobs report that just landed on April 3rd, and this one has a complicated read that matters a lot for what happens this week. The headline number came in at 178,000 jobs added in March. The market was expecting 60,000, that is almost 3 times the forecast on the surface. That screams strong economy, no rate cuts, dollar stays strong, silver stays under pressure. But here is what you need to know about this number before you take it at face value. 76,000 of those 178,000 jobs came from a single sector healthcare, and specifically from workers at Kaiser Permanente returning from a strike. These were not new jobs. They were strike-affected workers coming back to payrolls after a labor dispute ended. Strip that out and you get a number much closer to 100,000, which is decent but not spectacular. Additionally, the February number was revised down from a reported decline of 92,000 to a revised decline of 133,000. The labor market was weaker than it looked in real time. And here is the most important detail of all for silver holders. The March jobs data was collected during the pay period that included March 12th. The new tariff announcements that came on April 2nd Liberation Day's anniversary happened 21 days after that survey date. Every company that has paused hiring, every business that has shelved expansion plans, every manufacturer that is rethinking supply chains because of new tariff uncertainty, none of that shows up in the March data. The first real tariff impact on the labor market will not appear in official data until the April jobs report, which does not release until May 8th. This means the strong NFP headline is, in a very real sense, a snapshot of a world that no longer exists. The labor market picture from mid-March is already outdated by the new trade policy environment that kicked in on April 2nd. Smart institutional money knows this, which is why the market reaction to the strong NFP has been muted and confused rather than the clear dollar surge and silver sell-off you would normally expect from a number that tripled consensus estimates. Subscribe and hit the like button right now if you want to keep getting analysis that reads the details, not just the headlines. This is exactly the kind of context that makes the difference between reacting and understanding. Subscribe, hit the bell. Let's keep going. Force number 4 is the FOMC meeting minutes dropping on Wednesday, April 8th. This is the most important single event for silver holders this entire week. The minutes are the detailed record of what Fed committee members actually discussed at their most recent policy meeting, not Powell's press conference summary, the real internal deliberations, what they were worried about, what data they were watching, what would change their minds. If the Wednesday minutes reveal that Fed officials discussed stagflation risk, meaning they acknowledged both the inflation pressure from oil and the economic slowdown pressure from tariffs simultaneously, that is a silver bullish read, because it means the Fed is caught in a situation where it cannot aggressively fight inflation. With rate hikes without risking serious economic damage, a trapped Fed that cannot hike is a Fed that eventually has to cut when the economy weakens enough, and rate cuts are what silver is ultimately waiting for as its macro tailwind. If the minutes read hawkish, if the committee focused exclusively on inflation risks and showed no flexibility toward the idea of rate cuts, expect renewed dollar strength and silver selling pressure. Now let me talk directly to holders, because the rest of this is specifically for the people who are not trading silver but who own it and are living through this volatility. Here is what overnight volatility means for holders versus traders. For a trader, a 7% move in a session is either a profit opportunity or a loss to manage. For a holder, it is noise in a longer story, and the question holders need to answer is not what silver does in the next 12 hours. It is whether the reasons they bought silver are still intact. So let me go through those reasons systematically and tell you which ones are still fully intact and which ones have changed. The 6-year structural supply deficit, still completely intact. The Silver Institute has confirmed the market is on track for its 6th consecutive year of consuming more silver than it mines and recycles. This has not changed by 1 ounce because of the Iran war, the NFP number, or the overnight price moves. Industrial demand from solar EVs and AI infrastructure, still intact and growing. Oil above $100 is actually accelerating government investment in renewable energy, which accelerates silver demand from solar installations. Every day that oil stays expensive is another day that the energy transition moves faster. BlackRock's research team noted that solar photovoltaic technology accounted for nearly 29% of total silver industrial demand in 2024, up from 11% in 2014. That trajectory continues regardless of short-term price moves. The COMEX physical market stress, still intact. Registered inventories are still below where they were before the January delivery episode. Physical demand from institutions demanding real bars over paper claims has not disappeared. The Shanghai premium over Western prices, while it has fluctuated, continues to signal that physical buyers in Asia are willing to pay more for real metal than the paper price in New York reflects. The gold to silver ratio, at around 65-1 right now, this still signals that silver is historically cheap relative to gold. The long-run historical average is 50-60-1. The last time silver was this undervalued relative to gold for an extended period, it subsequently outperformed gold substantially over the following 12 to 24 months. What has changed is the timing of the macro tailwinds. Rate cuts that were expected in the first half of 2026 have been pushed to late 2026 or even into 2027 by the Iran war's impact on oil and inflation. That delay is what is causing the short-term headwind. The fundamental story has not reversed. The timeline has stretched. This distinction is everything for a holder. If your thesis was that silver would go from $70 to $100 in the next 30 days because of the structural deficit, the Iran war has temporarily made that timeline longer. If your thesis was that silver's dual role as an industrial necessity and a monetary metal positions it for significantly higher prices over the next 2 to 3 years because of the combination of structural deficit, growing industrial demand, and eventual monetary policy normalization, that thesis is as intact today as it was in January when silver was at $120. Here are the specific things holders should be watching this week in order of importance. Wednesday, April 8th, FOMC minutes at PM Eastern. Read the tone. Dovish or stagflation aware equals silver support. Hawkish equals continued pressure. The dollar index every morning before you open a silver chart. If DXY is declining, silver has air to move. If DXY is rising, silver faces friction. Brent crude oil prices overnight. Oil down equals inflation theories equals potential silver support. Oil up equals the opposite. Any Iran ceasefire or de-escalation news? This is the single event that would most quickly remove the near-term headwind. If oil drops back towards $70 on a resolution of the conflict, the macro picture for silver improves dramatically within days. The $67 support level on silver, if silver breaks below $67.34 and closes there convincingly, the next meaningful support is the 61 to 65 zone. Above 67, the consolidation continues. Above 72, the short-term bias begins to shift toward neutral. The bottom line for holders in a single clear statement: the reasons you bought silver are still there. The timeline has extended because of a war you did not plan for that created an inflation shock that delayed Fed rate cuts. The overnight volatility you are watching is real people making real bets on short-term outcomes of a situation. That changes daily. It is not telling you whether the structural case for silver over the next 2 years has changed. It has not. The people who panic sell into this volatility lock in a loss on a position that has not fundamentally broken. The people who add at current levels with full understanding of the risks may look back on this period as an obvious entry point once the macro clears, and the people who simply hold, check the fundamentals rather than the hourly price, and watch the 4 signals I just gave you, they have the best chance of being on the right side of what JP Morgan, Goldman Sachs, UBS, and BlackRock all still project, which is a silver price meaningfully higher than where it sits today before 2026 is over. One more thing before the call to action. The most dangerous thing in a volatile market is not a wrong position. It is an emotional position. Holders who check silver 17 times a day during sessions like these are not getting new information. They are just getting more anxiety. The price on your screen at AM is not telling you something different about silver's structural story than the price at PM. Watch the 4 signals I gave you at the specific times they matter. Rest of the time, let the market do what it does. Drop a comment below right now. Tell me which of the 4 signals you are watching most closely this week: the FOMC minutes, the dollar, oil, or the Iran situation. Are you a holder or a trader in this market, and how are you thinking about the volatility? I read every comment, and the conversation in this community is genuinely one of the best in precious metals anywhere. If this video helped you think more clearly about what is happening without telling you whether to buy or sell, share it with someone else who is holding silver right now and feeling confused by the overnight swings. 2 seconds. Pass it along. That is the most useful thing you can do with this content. I will see you Wednesday when those FOMC minutes drop.